Wow, what an exciting year. And we are really pleased to tell you about the results for last year. It was a very strong year for the fund. We were up 13%, and so it's one of the very strong years. And given the size of the fund, in terms of absolute increase in value, it was the largest on record.
Yeah, so that's the returns. We also have had inflows last year, albeit not as much as in 22 and 23. Still, more than 400 billion kroner is the third highest inflow we ever seen into the fund. And so if we put the different drivers together, the returns of more than 2,500 billion, the 400 billion plus in inflows, and add to that the change in the kroner value, which makes the fund look bigger in kroners, the fund had a change in market value of almost 4,000 billion kroners, the biggest ever.
Now,
it doesn't always grow to the top. Yeah.
No. We just want to warn again that this will not last forever. We are today out with stress tests, and which are on our website. We have different types of scenarios, and we laid out the assumptions behind these tests. And we think in several of the scenarios, we'll have very, very significant decline in the value of the fund.
Yeah, we also just want to remind everyone that a part of the returns that we collect is also actual cash returns, dividends from our equity investments, coupons on our bonds, rents from our real estate investments. And so last year we had almost 400 billion kroner cash return into the fund.
Now, whilst the absolute return was strong, the relative return was not. We were 45 basis points behind the reference index, which is the third worst year in percentage terms. And if you look at where that comes from, and we'll spend a bit of time on this, market exposure is where we are really index near in our asset management. And then you have security selection, which is a stock picking. Those two kind of pretty much canceled out last year. Then we have two other elements totaling 45 basis points. Real assets is our real estate holdings. And the way we report the relative result is that we report the value of the real estate relative to what we would have made if that value was invested in a combination of stocks and bonds. The value of real estate was roughly flat, but since the stock market went up so much, there is a negative result there of 25 basis points. The 20 basis points on allocation consists of two things. We had an underweight in equities, and we also had an underweight in the largest tech companies in the US. So that's the 45 basis points. We have to look at the relative performance in a longer term time horizon. We've had some strong periods. We've had a weak period now for 2 years. But still, since the inception of the fund, the excess returns have been 25 basis points per year. So, different asset classes, Trond.
Absolutely. So the fund is invested in 4 asset classes, as you see on this chart. Equities, fixed income, real estate, and infrastructure for renewable energy. And the return on each asset class you can also see with equities outperforming the other asset classes significantly. 18% is a very, very strong year. So we'll go through each of these asset classes in turn and explain what the main drivers were. Equities first, remind everyone, this is the largest asset class, more than 70%. The starting point is 70% invested in equities, and 20% return on that almost is the biggest driver behind the fund's return this year. Now there has been differences across markets. In particular, we've seen a very strong performance in the US market, and here you see the US market in light blue, and you see the European broad markets in the more orange color. And what you can see is also that this difference became much more apparent through the election and after the election. This is still a long-term trend that we've been seeing. Over the past 10 years, we've seen the US equity market significantly outperforming the European market by a magnitude of almost 3 times over the last 10 years. Now, this is also, of course, driven by different sector composition in the different regions.
Absolutely. And we saw that last year as well. Technology really, really strong, of course, driven by AI-related stocks mainly. Also, financials were very strong, and it's a combination of interest rates staying higher for longer, and also a steepening of the curve, since a lot of banks finance themselves in the short end and lend in the longer end. That's a very profitable positioning to have. If you look at then the impact on the sectors, massive gains from technology, more than 1,000 billion kroner, just incredible returns. On a stock-specific basis, you see Nvidia being the biggest gainer for us. It became the largest company in the world last year, followed by big returns from Apple and the other superscalers and technology companies. A lot of these companies are tied into the same value chain. So Nvidia designs the chips. It's being produced in Taiwan. It's being sold to the large tech companies. And you see it on a day like Monday, earlier this week, what the impact can be when you have a correction which is related to this value chain. Now, many of these companies are now bigger than countries.
They are. So let's put it into perspective. This is our portfolio, single name companies, the biggest ones, compared to our combined investments in selected countries. And what you can see is, the likes of Apple, Microsoft, Nvidia. Our holdings in those companies are larger than our combined holdings in, for example, Germany, France, or even India. So these are massive companies, which means that there is an increasing concentration risk in the equity markets and hence in our portfolio. This graph shows you how much that concentration for the top 10 holdings has gone from roughly 8% back in 2017, and now is nearing 20% of our equity portfolio in only 10 holdings. Now, part of the story behind this is, of course, the merger and acquisition that goes on the exchange, but there is also a long-term trend that we have talked about previously, where companies choose not to list themselves and stay private for longer. So this shows you over the last, 20 years plus, how the number of listed companies in the US has fallen from almost 7,000 to 4,500. And by the same time, the privately owned companies has grown from 2,000 to almost 12,000 or more than 11,000. So this is absolutely significant. And of course, what we're talking about here is the technology sector, Nicolai.
Yeah, absolutely. A lot of things been going on in the tech sector, and to shed some light on this, we have woken up our portfolio manager, Doug Schell. Doug, you are live from New York. What's the reason behind the strong performance here?
Hi, Nicolai. Well, for the second year, AI has been the main driver of tech performance, but this time with much more dispersion in returns. In the semiconductor subsector, in 2023, almost all the companies performed well. Well, the past year, overall performance was great, despite many of the semi names being flat to down. Returns were driven by only a few stocks, such as Nvidia, which on its own increased in value by something like 25 trillion kroner, not due to multiple expansion, but due to extraordinary earnings growth as a result of huge AI chip demand. AI also drove earnings for a number of other mega-cap tech stocks, such as Meta and Google, who used AI chips to power really incredible advertising tools. These AI tools are able to automate every part of an ad campaign, from actually creating the ads, to choosing who to show the ads to decide where to place them, whether that's on search or video or feed. If you run a small business, having an AI tool run your ad campaign while generating more sales for you at a lower cost is a game changer, and one that drove strong sales for Meta or Google.
And what do you see going forward here?
Well, investors do have high expectations for mega cap tech stocks in 2025, which is definitely a less comfortable place to be. In order to continue their success, tech companies will have to continue to invent new products and services that their customers are willing to pay for. If there's an area that could surprise in 2025, it could be AI in the physical world. One example are robotaxis, which became widely available in San Francisco and LA in 2024, but could be rolled out far more widely. The transportation sector is an enormous industry, so robotaxis represent huge opportunities for companies including Tesla, Google, and Amazon.
Very good. Big thank you. We are moving on to external managers. You know, we have roughly 5% of the fund, which is outsourced to external managers. It's been a very, very profitable part of the firm. And we'll hear from Isabel why this has been so strong. We need a bit of sound from you.
Sorry about that. Yeah, you're right. So 2024 has been another successful year for our external fund managers who once again generated excess returns. And this is thanks to our 114 locally based fund managers spread across 50 different cities all over the world. And I do think that there are several reasons as for why they keep on outperforming. First of all, through deep company analysis, local expertise, and extensive on-the-ground research capabilities, they have been able to select the right investments. But also kind of being close to companies and their supply chains has kind of enabled them to generate exceptional returns by identifying trends early and often before these opportunities become widely recognized by the rest of the market.
What are some of the events you've seen over the last year?
Well, so there's a lot of exciting things happening, but I do think that one of the markets that we are most excited about is India. We now have a total of 7 managers based locally here, both in Mumbai and Delhi, and they've been able to generate excess return in a very challenging market. They've steered clear of these very expensive smaller companies that we saw a lot of in 2024 and rather focused on larger quality companies, which has been very beneficial for our portfolio. And I also think that India in general has shown quite impressive resilience and, of course, remarkable growth over the past 40 years. And this is despite various political and economical challenges. And looking ahead, we do expect this growth to continue, mainly driven by a young and growing workforce. But we also think that this growth could increase even further with government support and more infrastructure investments. So this is definitely a market that's been very exciting to follow for 2024, and we're just as excited for 2025.
Very good. Thanks a lot. Now, Trond, fixed income.
Fixed income, the second biggest asset class, almost 30% invested in fixed income globally. The return was 1%. The yield on the portfolio, the running yield, is 4%. So that means that interest rates through the year actually increased, and hence the bond prices fell. The other feature of the market, and here you can see the most important interest rate in the world, arguably, the US Treasury 10-year, was volatile. That's the key takeaway from 2024. But to shed more light on that, we want to have and bring in Malin Nordberg. So she's in New York now. She's in the leader group. We're a global organization, and we have a permanent president, a person from the leader group also in New York, and that's a good thing. So now, Malin, good to see you. What can you say about what's your impression of the fixed income markets last year?
Hi, Trond. So I would say that 2024 was a surprising year for bonds. So going into the year, most market participants were expecting inflation to finally be under control, rate cuts from central banks, and predicting this would be a great year for bonds. However, most government bond markets ended up with flat or negative returns. And for the 4th year in a row, bonds actually had worse performance than stocks. And this is despite both the Federal Reserve in the US and ECB in Europe cutting rates significantly last year. And most of the other global central banks also cut rates, with the one outlier being Bank of Japan, who hiked rates for the first time since 2007. And what's interesting here, and just to take the US as an example, is that despite the Fed cutting rates 100 basis points this fall, 10-year yields were actually significantly higher at the end of the year. And that's not something that we normally see in a cutting cycle. So while the central bank is lowering rates, the longer rates are going higher. That's very unusual.
So how do you explain that, Malin?
So there can be multiple reasons for why this is happening. So to name a few is that inflation has been more sticky than expected and growth has been pretty resilient. So that might impact the ability for further rate cuts. Another reason could be higher government spending and higher deficits, which increases the supply of bonds in the market and leading to investors requiring a higher compensation to hold these bonds. So I think both of those themes are going to be really interesting to watch into 2025.
Okay, great. Thanks. Looking forward to that. So we go to real estate. So we have a combined real estate portfolio, meaning that we invest both in listed and unlisted real estate. So the unlisted part had a negative return, almost flat, but negative of 1%. The listed performed pretty well at 10%. So the combined portfolio, these are almost 50-50, is a weighted 5% for the portfolio as a total. Now, real estate has had a difficult period. This chart shows our unlisted real estate holdings and the accumulated capital return. So we're not counting, the running return because that comes in addition, but just the capitalization of our investments. And you can see that it peaked out in 2022 and has fallen quite sharply, albeit maybe we see some signs of kind of a stabilization of those returns. But to get more light on that, we turn to John McCarthy, head of our US investments on the real estate side. Hi, John. Good to see you.
Thank you, Trond. Good to see you as well. And good morning, everyone.
Share your perspective on what's going on in the US real estate market.
Absolutely. And thank you for letting me update you and everyone on NBIM's real estate business. Trond, as you said, 2024 marked a turning point for most real estate markets. After 2 challenging years where property values went down, especially for office buildings, we started seeing some good news in the second half of the year that suggests things are beginning to stabilize. While there's still some uncertainty about interest rates and inflation, we became more optimistic late in 2024 as we got a clear picture on where the economy is headed. Looking at the US specifically, people working from home continued to affect how office buildings are doing, but we saw progress in 2024 as more people gradually returned to offices. The best office buildings in good locations are doing better than others, and we think this will continue as companies figure out their long-term plans for how they want their employees to work. Logistics properties, meaning warehouses and shipping facilities, are still doing very well, helped by online shopping and companies changing how they move and store goods. We remain confident in this segment of the real estate market. Our investments in publicly traded real estate companies continue to recover in 2024 after losing a lot of value in 2022. The portfolio benefited from exposure to data centers and senior housing, which stayed in high demand throughout the year. While some uncertainties remain about the economy, we're carefully starting to invest more in real estate again. We're focused on high-quality office buildings, warehouses, and retail properties that are now selling for lower prices. We have recently invested about $4 billion into real estate that aligns with our strategy. For example, we recently increased our ownership in 8 office buildings in Boston, San Francisco, and Washington, D.C., giving us full control of these properties. While many investors are staying away from office buildings, we saw this as a good opportunity to buy high-quality buildings at attractive prices. We believe we'll benefit from buying properties now, while other large investors are less able to do so. So to sum up, while the real estate market still faces challenges, Trond, 2024 gave us reason to be cautiously optimistic.
That's good to hear. Thanks a lot, John.
Yeah. Sure.
Last asset class we have is renewable infrastructure. And the headline number is negative 10%. Now, it's kind of a bit of a complicated number because the way we get to the valuation of these assets is to look at the long-term projections for power prices and also discount the revenue streams back to today. So it's a function of forward pricing on the electricity side and interest rates. That's what explains the negative number. But we have Harald here to shed some light on it. Harald, what are you saying?
Yes, hello, Nicolai. Yeah, as we see from the green line in the graph on the left, which is our custom renewables index, large cap renewable stocks have had a difficult year in 2024, both in absolute terms and even worse relative to the general stock market, shown by the black line in the left graph. this is representative of the general market sentiment around renewable infrastructure globally in 2024, despite what we see in the graph on the right, namely that renewables had another record volume growth year in 2024, for the first time surpassing 600 gigawatts of new renewable production capacity installed. The negative developments in both public and partly also private valuations are mainly caused by a rising interest rate environment, as you said, but also a failure by the industry to deliver on even higher growth expectations, and also stronger focus from customers on security of baseload supply. For us, actually, this is good news, as we have deliberately kept most of our powder dry. We have deployed less than 10% of our renewables infrastructure mandate so far. We now see opportunities to enter into the ownership of more favorably priced renewable assets in the coming years.
Very good. Thank you so much.
That wraps it up.
Yeah.
So key points, just to reiterate, 13% returns on the fund, a strong year. That means more than 2,500 billion kroners. We did underperform the broader market by 45 basis points, and the fund value stood at almost 20,000 billion at year end.
Also today, or actually the one to the left, we published yesterday, is our holdings list. We now report this twice a year, so you get it at the full year stage now, and you also get it at the half year stage. So as you know, we spend a lot of time and effort on being the most transparent fund in the world, and I don't think anybody else is even close when it comes to this. We are also today publishing an update on our strategy. We have a 3-year strategy period. We had an update, where are we after year 1? We did that last year. This year, where are we after year 2? So that's also out there, and you can see exactly what we have been working on. And then lastly, the stress tests, which we showed you earlier today, that's also on the web, so you can have a look if you want. Also to remind you that you need to block out 29th of April. This is being streamed from lunch and onwards. We have some phenomenal speakers. And what we will talk about is what makes a great company, so it should be relevant for investors, for you guys, for everybody who runs a company, and we think it should be very, very interesting. Combination of business leaders, academics, and investors. So please note that date.